Yo, what's up, guys? We're actually going over 10 buy and hold forever dividend stocks, and I've carefully selected these so they can easily afford the dividend. And lots of these even have a lot of room to grow the dividend. Some are even doing some stock buybacks. So, yeah, hope you'll join me today as we go over 10 buy and hold forever dividend stocks. They're so safe that once you buy them, you don't even need to look back, you just hold them forever. So, let me actually show you the first stock. I wanted to show you the first dividend stock, and it's actually ticker symbol DG or Dollar General. And this one's actually at a pretty good valuation right now because look at how the stock price is done. Why has the stock price fallen like this? Well, let's actually dig into the financials and I'll show you why. And the numbers aren't even that bad because if we look at this, so this could be a little bit concerning. So look at this. The net income is down 30% year over year, okay? So it's down 30%. Here's the balance sheet. It's pretty safe. It's at 79%. Same from 1 year ago. But anyway, we want to look at the operating cash flow. So $535 million, all right? So $535 million, and their dividend from that only cost them $129 million. So actually, they can easily afford the dividend and have room to grow it in most cases. And if we go to their issuance retirement of stock program, they have it in the two most recent quarters because of the higher interest rates. But look, they used to buy back tons of their own stock. Like in that one quarter, they bought back over $1 billion worth, and just the market cap is under $50 billion. So if they buy back another $1 billion worth of their shares, that's buying back, 2% of all the shares just in one quarter. But anyway, let's see how much cash they have. Hey, $353 million of cash, not bad. So here's their diluted normalized EPS. This is what I actually like to look at. So they have $2.13 to basically distribute out to shareholders. And their dividend only cost 59 cents from that. And they've had some decent growth, Since 2020, it was 36 cents, and now it's chilling at 59 cents. So I wanted to pick Dollar General as the first stock on the list because I believe it's at a very good valuation. Their dividend doesn't cost much, so their dividend from a numbers standpoint is very safe. They're not going to have to cut it, in my opinion. Of course, nothing in this video is financial advice. So let's actually dig into the next dividend stock. All right, you guys. So the next stock is actually ticker symbol TXN or Texas Instruments. Not Texas Roadhouse, but Texas Instruments. Now, this one is a semiconductor play. Now, they're actually yielding 3.57%. Now, that's a really good yield, 3.57%, a growing yield, and the stock has done really good. So let's dig into the financials. The market cap is $132 billion. So let's actually check out the dividend growth. So they just rose the dividend from $1.24 to $1.30 in the most recent quarter. So that's a really good sign. And the dividend growth is insane on this one. In 2020, it was under a dollar, it was 90 cents. Now it's $1.30. So not bad for such a huge market cap company. But let's actually see why they're down their stock price. So their net income is down 25%, but that's comparing to a time where semiconductors in their space were doing really good. But let's look at their balance sheet. So this is pretty safe. 47% and their assets are growing every single quarter. Now the ratio isn't getting better. It's at 47%. It was 44, but the actual assets are growing. So that's good. And here's their operating cash flow. This is what we want to look at. So $1.94 billion, even down 20% year over year, they can still afford the 3.5% dividend yield. And it only cost them $1.13 billion. So yeah, they can easily afford it. And if we go to their other financials, like their normalized diluted EPS, $1.85. Their dividend, remember, cost $1.30. And let's see, cash on hand. Hey, they got $1.92 billion of cash. That's pretty good. And check out their total common shares outstanding. They're actually not diluting you year over year. So you're actually down 0.22%. So if we go to their issuance retirement of stock program, they used to buy back a ton of stock. Hey, hopefully they'll resume this in the coming quarters because they used to buy back a ton of stock, just like Dollar General. So once these companies return back to zero interest rate environments, they're going to be, buying back their own stock, and it's going to do insane in the next bull cycle. So hey, that's Texas Instruments. Let me know your thoughts. Let's get into the next stock. All right, you guys. So the next dividend stock is actually ticker symbol PLD. Now, this is the largest holding in basically every REIT ETF because it's the largest REIT by market cap. And like for example, ticker symbol VNQ, which is the largest REIT ETF. You could just invest in this. This is a steal right now. So this is VNQ, and its dividend yield is 4.78% with an expense ratio of 0.12%. So that means they take out 0.12% of your investment every single year. But anyway, let's actually dig into the financials of Prologis because it's actually been getting hit over the past couple of days here and weeks, but the financials are amazing. So let's dig into it. So the dividend yield is 3.39%. We'll quickly look at the dividend growth, some of the best dividend growth, raising it from 58 cents in 2020 to 87 cents now. But let's actually dig into the numbers. So this is a REIT, so we actually want to look at the core FFO, which is this number down here. And in the most recent quarter, they absolutely crushed it. I don't even know how they did this. They didn't even grow their assets. They didn't grow their assets. Look, their assets are the same, and yet the numbers were $1.97 billion of core FFO. They didn't sell any assets, so let's actually see how much their dividend costs from that. So their dividend only cost $806 million, so they can easily afford that. And are they diluting you as the shareholder? Because remember, REITs have to issue shares to, gain new capital. So this is when they merged with another REIT. So we can ignore that part right there. But as we can see, it's the same amount of shares from 1 quarter ago, basically. So you've barely been diluted with ticker symbol PLD. And let me know your thoughts on this one. This is, in my opinion, super safe as it can get for a dividend stock. And it has some insane dividend growth, 3.39%. Honestly, I might buy some of this stock later today because this is a steal. I love REITs because they have to, by law, pay out 90% of their taxable income. So as dividend investors, we all love REITs. So let's actually dig into the next dividend stock. All right, guys. So just a bit ago, we looked at Texas Instruments. We're actually looking at Texas Roadhouse, which is doing better than Texas Instruments. That sounds crazy, but the dividend yield isn't as high. It's 2.08%. But remember, that's really high for a restaurant. Restaurants are a tough business to run, very low profit margins, but they seem to do it very well. Texas Roadhouse is one of the best management teams, in my opinion, but check out the dividend growth here. So obviously had to get cut during the pandemic, but they brought it right back as soon as it was over, and now it's chilling at 55 cents. So that's really good. So let's see, can they afford this? So their net income, $65 million. Hey, it's up year over year, only 2%, but hey, that's really good. Their balance sheet is down 2% from assets to liability ratio. So check this out. It went from 58 to 56. So hey, and they grew their assets. So that's really good. But this is what we want to look at, their actual free cash flow, operating cash flow, $102 million. All right. So from that, wow. They can so easily afford the dividend and double it if they wanted to. This could be a 4% yielder if they wanted to. The dividend literally only costs $36 million. They can easily afford the dividend. Here's their normalized diluted EPS, 95 cents in the most recent quarter. Look at this. They have no debt. So right now they have zero debt. I love that. And the cash on hand, well, the cash has been getting depleted. Wow, I didn't even realize that. Why is their cash being depleted so much? So there's $69 million of cash. Did they do some stock buybacks? Hey, they have been. Yeah, that makes sense. They've been buying back their own stock, and they've been buying back their own stock every single quarter. So yeah, that was my analysis on Texas Roadhouse. Literally no complaints with this stock. I'm not even complaining that they cut their dividend during the pandemic because that was honestly the smart move. No complaints here with Texas Roadhouse, a near perfect dividend stock. And let's actually dig into the next one, which is actually ticker symbol UNP or Union Pacific. And they basically have a monopoly on the western side of the United States for railroads. So let's actually see how they're doing because their dividend right now is 2.5%. So that's a pretty attractive dividend. But let me tell you, they're not just a dividend play. They're a stock buyback play because let me show you how much free cash flows they're bringing. So look at this. Net income, now it is down year over year, but that's still a lot of money, $1.5 billion. Here's their assets to liability ratio. The ratio is down, but all railroads, because their income is so predictable and consistent, they can get these very high amounts of debt for low interest rates. So the fact that they have a lot of debt isn't concerning to me. And the ratio is actually down from 81.5% to 79%. So anyway, let's look at their free cash flow. So $2.13 billion, all right? $2.13 billion. How much does their dividend cost from that? Literally $792 million. And why is it costing less from 1 year ago? Because they're buying back their own stock. Now, they haven't in the two most recent quarters, but look at this. This could be a little bit concerning because they stopped, but look how much they used to do it. Then this 1 quarter, they bought back $3 billion of their own stock in 1 quarter. Remember, the market cap is $150 billion. That's like buying 2% of your total common shares outstanding. Like, look at this. The actual total common shares outstanding are down 0.49% from 1 year ago. So, hey, you're not even being diluted. You now own more of the company. They have $750 million of cash on hand. But yeah, what's their total normalized diluted EPS? $2.51. And their dividend of that only cost $1.30. Now they do have a little bit high debt, but remember their income is so predictable that they can easily get it. So anyway, let's dig into the next dividend stock, which is ticker symbol ABBV. One of my favorite holdings, this one's in SCHD, and look at how the stock is done. Even at these super high prices, look, it's basically just gone straight up in 5 years. But even at these super high prices, the dividend yield is still 4.47%. So 4.47%, that's crazy. Look at the growth on this one. They're actually going to raise the dividend next quarter because remember, they don't keep the dividend the same for more than 4 quarters. So next quarter, it should be, over $1.50, something like that, because look at the growth. It's crazy. But anyway, let's actually dig into their financials. So net income, it stagnates. Look at this. You got some quarters that are really low, but look at their assets to liability ratio. It is pretty highly leveraged, but that's okay because this is a pharmaceutical play. Because look at their actual cash flows. $7 billion, $7.57 billion in the most recent quarter. And how much does their dividend cost from that? So it only costs $2.63 billion. So obviously they can afford the dividend and even have room to raise it. And check out how much cash they have on hand. Just in cash, they have $13 billion. Okay, that's a ton of cash. But how much total debt though? So they have $60 billion of total debt, but check out the debt. It's actually down 12% from 1 year ago. So they're paying off the debt and still have a ton of cash because as they pay down the debt, the cash gets depleted, but they still have a ton of cash, 13 billion. That's a lot. So check out their total common shares outstanding. It's actually down from 1 year ago. Not a ton, but if we check this out, they bought back, 2 quarters ago, $1.89 billion worth of shares. And that really helps you out as a shareholder because look at this, it went down from 1.77 to 1.76. Not a huge, dent. It's only down 0.16%. But hey, the fact that they sometimes do stock buybacks is a good sign. And in my opinion, the dividend's really safe. They have a ton of cash and just look how the stock is done. It's done amazing. So yeah, let me know your thoughts on Abbvie. Let's get into the next stock. All right, so this dividend stock, I bet you'll find really interesting if you haven't seen it before because this is ticker symbol AFG or American Financial Group, and they're actually an insurance company. And look at how much they're paying out in dividends. So they have their normal 71-cent dividend that they just rose from 63 to 71, but look at these special dividends that they do. They used to do these a ton back in 2021, 2022. Look at this, they did an $8 special dividend right here. And the stock price is $108. So an $8 return is crazy. So here's their assets to liability ratio. Now, all insurance companies have this. We just want to see if their assets are growing. So it went from 29 to 30 billion. So yes, it's growing. Now, what do I mean by that? Because look at this. So it said they have 30 billion of liabilities. Well, their actual total debt is only $1.47 billion. And their actual cash on hand is $1.22 billion. So they can pay off almost, all their debt in 1 quarter if they wanted to. So they're not even that highly leveraged, but we want to see how much their dividend cost them. $52 million. Why did it cost $39 million? That's because that's when they were doing the special dividend, back here, that $8 a share dividend. But anyway, let me show you their diluted normalized EPS. $2.17. So that's why they're able to do these insanely high dividends because look at this. Their dividend only cost 71 cents. Remember, their actual real dividend only cost 71 cents. That's why they do the bonus, $1.50, just to give some extra money to the shareholder because they're making so much money. And they've been stockpiling up cash, $1.22 billion of cash on hand. That's really good. They can almost pay off all their debt. And in the 3 most recent quarters, they've been buying back their own stock, which I love when companies do. They bought back $83 million in the most recent quarter and then $39 million again. And they haven't done that in a long time. That's really good because they're buying their own stock at these discounted prices. So it's really good for the shareholder. I really want to buy some shares of ticker symbol AFG. I'm really looking at ticker symbol AFG, PLD, and Texas Roadhouse. Those are 3 dividend stocks, man, that I would just buy and hold forever and never look back. I want to actually show you my Moomoo portfolio real quick because I want to actually deposit and add one of those 2 different stocks here. So we can see how the Moomoo portfolio is doing today. We got some stocks going up, some stocks going down. We're still barely up on our Fiverr position. We're up 0.59%. The earnings on Fiverr were really good, but anyway, I'm getting off track here. We're supposed to be looking at dividend stocks. So that's ticker symbol AFG. Look how it's done since the pandemic. It's done absolutely amazing. And look at all the, the D's right here. Look at all the dividends they've been paying out. It basically at one point was a monthly payer. This looks like a monthly paying dividend stock. Anyway, let's actually dig into the next dividend stock, which is ticker symbol AMT or American Tower Corp. Now, this one's a real estate investment trust, so they have to by law pay out 90% of their taxable income. But let me show you the dividend history. You're gonna love this. and I mean love it. Look at the dividend growth. I've never seen any company do this ever besides one other company, which is ticker symbol CCOI, but they raised their dividend literally every single quarter. I don't believe it. Look at this. Went from a dollar, it went from $1.10 to $1.14 the next quarter, then $1.20. It just goes up every single quarter. So as a dividend growth stock, this is really good, and the yield is 3.51%. That's a really high dividend yield. So they are a bit highly leveraged. It is a cell tower REIT, so it's pretty normal, predictable cash flows. But we actually want to look at their core FFO. This is what we look at for REITs. And man, $1.3 billion in the most recent quarter. Look at the growth on this. Absolutely amazing. So look, $1.3 billion. How much does their dividend cost of that? Cost $731 million. And it goes up every quarter because they raise their dividend every single quarter. So it makes sense. And are they diluting you as a shareholder? Remember, REITs love to do that. Literally, no. Only 0.12% from 1 year ago. So basically nothing. So if we see how much they're issuing, they're basically issuing no shares. They're also chilling on $2.12 billion of cash. What's the market cap of this stock? $86 billion. Okay, so $86 billion. So if you love dividend growth and a good valuation, look at this. It's at the 2020 pandemic lows, and we just looked at the core FFO. The core FFO was really good. In my opinion, the dividend is very safe. They could even raise this to probably $2. They're going to raise this to $2 one day. It's not a matter of if they're going to do it. It's a matter of when and how soon. But anyway, that's ticker symbol AMT. Let's get into the next dividend stock. All right, guys. So Tapestry just reported earnings. Let's see how they did, because check out the actual stock price. It is done awful. They even had to cut it. They just resumed it, but their yield right now is 5%. 4.99%. They just reported earnings. I haven't looked at them. So we're going to find out together, is the dividend yield sustainable? Let's find out, because we saw what happened to VF Corp. VF Corp just cut their dividend. They're not doing good at all. But check this out. Their net income, $195 million. Total revenue, it is growing, but 0.44% year over year. Not crazy good. But let's check out their balance sheet. So their assets to liability ratio went down. It's now 66%. So that's a good sign. But this is the number. Ooh, this is what I was coming here for. So look, $75 million in the most recent quarter. And if we look, that one quarter had $600 million. So we kind of have to take an average. We'll just call it, on average, they make $200 million a quarter. It could be more, could be less. But anyway, the dividend actually cost $80 million. That 5% dividend yield cost $80 million in their normalized diluted EPS. Check this out, is 84 cents per share. How much is their dividend costing that? Oh, so their dividend only cost 35 cents. And look, they just rose it from 30 to 35 cents. So 30 to 35 cents. That's why the dividend cost just went up in the most recent quarter. That makes sense now. So look, their total cash paid dividend went from 69 million to now 80 million just because they rose it. And they rose it quite a bit. That was pretty good. And check out their issuance retirement of stock program. They usually buy back $200 million of shares. Wow, they usually buy back a ton of shares, but it looks like in the most recent quarter, they didn't buy back any, which could be a little bit of a weird sign. Are interest rates affecting them? I'll actually find out. Okay, yeah, so check out their interest expense. It was $13 million, and that's not that, that's not good, because 1 year ago it was $7 million. Now it's $13 million. Their cash on hand is $622 million. Seems like it's average, not crazy. But anyway, that was Tapestry stock. Let me know your thoughts on it. At the end of the day, the dividend seems safe, but it's a very volatile stock. Probably this one's more risky. And what stock are we on? I haven't even been keeping track. Is this 9 or 10? Whatever it is, we're going to do one last dividend stock. And I haven't even picked out what stock I want to do yet. Oh, yo, look at Krispy Kreme, ticker symbol DNUT. Their stock right here, they're famous. They're public for one reason. And that reason is they give away donuts. Krispy Kreme, it gives away donuts all the time. All right, you guys, I'm getting distracted. I'm going to show you the last dividend stock on the list, which is actually ticker symbol KDP, or Keurig Dr Pepper. So Keurig and Dr Pepper merged, and now they're Keurig Dr Pepper. And the dividend yield is 2.75%. So let's see. What's the growth of that? It just went from 20 cents to 21.5 cents. So, hey, that's not bad at all. Or at least is some growth there. But let's check out the net income growth. So look at this, $518 million from 1 year ago. That's definitely a good sign. Look at their balance sheet, 51%. So the assets to liability have stayed the same. So they haven't issued any shares or diluted the shareholders. So let's see what their cash flows have done. So with the same assets from 1 year ago, okay, this isn't good. They're making less and less money. Let's actually see if we can find out why. How much does their dividend cost, by the way? So their dividend cost $279 million. Oh, snap. Their normalized diluted EPS was negative in the most recent quarter. That's not good at all. This went from a dividend stock to buy and hold to a dividend stock to sell. What's their interest expenses doing? Let's see. Oh my goodness, they're paying $237 million of interest. That's because they have a lot of debt. How much debt do they have? $13 billion of debt, which is up 9% from 1 year ago. And the cash they have on hand is down 71% from 1 year ago. So I'm glad we're doing this analysis. They sometimes buy back stock, but they haven't in the most recent quarter, 200 million. So honestly, guys, this one I can't say is a super safe dividend. Y'all got pranked for the last dividend stock because I don't know how safe this one is. But anyway, guys, thank you so much for watching. If you enjoyed how I break down all the numbers and stuff, make sure you hit the like button for me. Also, if you want to support me because all revenue I make from this channel, I'm going to be investing into the stock market. Hit the join button. You can become a YouTube membership. It's kind of like a monthly subscription, and I would really appreciate it. You totally don't have to. I would much rather you leave a comment down below. Let me know your thoughts on this video.